The Complete Psychological Code, Trading in the Zone Masterclass. Section 1. The Tale of Two Realities. Imagine a high-floor office in a skyscraper overlooking a bustling financial district. Inside this office, two traders are sitting at identical mahogany desks. They are using identical state-of-the-art computers with identical high-speed fiber optic internet connections. They are both looking at the exact same charts, using the exact same software, and trading the exact same strategy. They have both been taught the same entry and exit rules. They both have $100,000 in their trading accounts. On the surface, there is no discernible difference between them. They are clones of one another in terms of resources and knowledge. Now, fast forward 1 year. The first trader, let's call him Jonathan, has had a phenomenal year. His account has grown by 60%. He is calm, he is composed, and he moves through the trading day with a sense of quiet, detached confidence. He takes his losses in stride, knowing they are just part of the process, and he allows his winners to reach their targets without interfering. He has achieved the dream of the professional trader, consistent, compounding wealth. The second trader, let's call him Michael, has had a disastrous year. His account is down by 40% and is on the verge of being blown. He is chronically stressed. His hair is thinning, his relationships are strained, and he spends his nights staring at the ceiling, replaying every losing trade in his head. He experiences violent swings of emotion, euphoria when he wins and deep, dark depression when he loses. Despite having the same strategy as Jonathan, Michael eventually decides that the market is rigged, his broker is cheating him, and the game is impossible to win. He quits in a cloud of bitterness. What is the difference? It isn't intelligence. Both men have high IQs. It isn't luck. Over the course of a year, luck averages out. It isn't a secret indicator. Jonathan and Michael were looking at the same RSI, the same moving averages, and the same price action. The difference is something far more hidden and far more powerful. Jonathan has cracked a psychological code that 95% of traders never even realize exists. He has discovered that the real battle in trading isn't against the big banks, the high-frequency algorithms, or the market makers. The real battle is against the millions of years of biological hardwiring that reside inside the human brain. Jonathan has learned that the greatest enemy he will ever face is the person staring back at him in the mirror every morning. Once you understand this internal battle, everything changes. The way you look at a candlestick chart, the way you feel when you enter a position, and the way you react to a stop-loss being hit will be transformed forever. Most traders spend 5, 10, even 15 years of their lives perfecting their technical analysis. They spend thousands of hours studying fundamentals, searching for the holy grail indicator, or trying to find that one perfect pattern that never fails. But the truth is, they are fighting the wrong war. The real enemy isn't a lack of information or a lack of market knowledge. The real enemy is fear, it is greed, it is the ego, and it is that nagging, desperate voice in your head that makes you doubt your strategy exactly when you need it most. What I am about to share with you isn't just another set of rules for buying and selling. This is an exhaustive breakdown of the psychological framework that separates the winners from the losers in the most unforgiving arena in the world, the financial markets. These insights are drawn from the foundational masterpiece, Trading in the Zone by Mark Douglas. This book has transformed more struggling amateurs into professional, high-income traders than perhaps any other text in history. Mark Douglas was a pioneer who clearly explained that the real edge in trading does not come from your math, your computer, or your software, but from your mindset. This masterclass is designed to help you break free from the exhausting cycle of emotional decision-making and start thinking in terms of probabilities, consistency, and a quiet, unshakable confidence. Section 2. The Analysis Trap. To understand why so many people fail at trading, we have to look at the 3 levels of analysis that every trader moves through. Most people start their journey with fundamental analysis. This feels like the most logical and safe place to begin. You study the company, you look at their earnings reports, you understand the macroeconomics of supply and demand, and you track global news, interest rates, and geopolitical events. The belief is simple and comforting. If you know enough about the underlying factors, you can accurately predict where the market is headed. It is an appealing approach because it offers a sense of intellectual control. It makes trading feel like solving a complex mathematical or logical puzzle. But as Douglas points out, for many people, this approach leads to a dead end of pure frustration. Why? Because the market isn't just a machine that processes data, it is a reflection of human beliefs and emotions. Even if your fundamental data is correct, in a logical sense, the price will not move until a critical mass of traders believes it should move. This is why markets often stay high when they should fall or crash on good news. That should have been bullish. When the market ignores your fundamentals, you experience a sense of betrayal. You feel like the market is wrong and you are right. This is the first step toward disaster because the market can stay irrational longer than you can stay solvent. When fundamentals fail them, traders usually move to the second stage, technical analysis. This feels like a massive breakthrough. Instead of asking why something is happening, you stop caring about the news and start looking at what is actually happening on the screen. You look at price patterns, moving averages, RSI levels, and support and resistance zones. It is all about recognizing repetitive human behavior in the market. For a while, this gives you real results. You feel like you are finally in sync with the pulse of the market. You begin to feel like you have a superpower. But then, the inevitable happens. Even the most perfect technical setups fail. You see a textbook head and shoulders pattern or a perfect bounce off a key support level, but instead of going up, the price collapses. You take a loss. Then you take another. Suddenly, your confidence begins to shake. You find yourself wondering, if I'm doing everything right according to the charts, why am I still losing money? This is the point where most traders quit. They assume they just haven't found the right indicator yet, so they go back to searching, jumping from one strategy to another in a never-ending loop of strategy hopping. That is where Mark Douglas brings in the real turning point, mental analysis. He argues that the true key to consistent trading success lies not in the market, but deep within the mind of the trader. It is not about how much you know about interest rates or how well you can draw a Fibonacci retracement. It is about how you think, how you feel, and most importantly, how you behave when you are under the intense pressure of a live trade. The market is a vast ocean of unpredictability. It moves in probabilities, not certainties. However, human beings are biologically programmed with a desperate need to be right. In the wild, being right meant survival. In the market, the need to be right triggers fear, hesitation, impulsiveness, and the destructive cycle of revenge trading. When emotions take over, even the best trading method in the world becomes useless. Douglas makes it clear that success isn't about having the right strategy, it's about having the right mindset to execute that strategy without interference from your ego. Consistent winners think in probabilities. They accept that any single trade could be a loser. They don't try to control the market, they focus entirely on controlling their own reactions. This shift from external analysis to internal awareness is the boundary line that separates the amateurs from the professionals. Section 3. The Freedom Paradox. Trading holds a magnetic allure that few other professions can match. It represents the ultimate freedom, the ability to work from anywhere in the world, to be your own boss, and to have no limits on your potential earnings. It is the perfect escape from the traditional constraints of a 9-to-5 job. As Douglas explains, this freedom is exactly what makes trading so attractive. Unlike most careers, trading has no boundaries. There is no one to answer to, no fixed schedule, and no earning cap. You can jump in with nothing more than a laptop and an internet connection. But with this absolute freedom comes a hidden danger that most people are completely unprepared for. Because there are no clear rules and no structure enforced by an outside authority, the trader becomes fully responsible for every decision and every consequence. This is a terrifying reality for the human brain. Most of us grew up in environments with teachers, parents, and bosses who provided the structure for our lives. We are conditioned to follow rules that are imposed on us from the outside. In trading, that structure is gone. Douglas points out that trading gives the illusion of unlimited possibilities, but most people are not mentally prepared to handle that much responsibility. The market does not care about your background. It doesn't care how hard you work, how much you studied, or how much you desperately need to pay your mortgage this month. It only responds to your actions. Without a self-imposed structure, without rigid discipline, and without clearly defined rules, the very freedom that attracted you to trading will become the thing that destroys your chances of success. Many traders enter the market with the wrong mindset, seeing it as a source of easy money. They believe that a few good trades will solve all their problems. This creates a dangerous set of expectations. When those expectations aren't met, when trades go wrong as they inevitably do, those expectations turn into disappointment, then fear, and finally, desperation. Douglas emphasizes that consistent success is not about finding a secret method. It is about managing yourself. It is about managing your impulses, your reactions to losses, and your desire to gamble. One of the biggest problems Douglas highlights is the deep-seated unwillingness to create and follow rules. Traders often resist rules because they think rules will limit their freedom. But in reality, in the world of the market, rules are the only things that truly create freedom. Rules protect you from your own emotional volatility. Without rules, trading is just gambling. You might win occasionally, but you will never have control. And without control, there is no consistency. The market rewards those who are prepared and disciplined, and it ruthlessly punishes those who are merely hopeful. Section 4. The victim mindset and responsibility. This leads us to the concept of taking absolute responsibility, which is perhaps the most difficult turning point in the entire process. Douglas lays out a hard truth. You are responsible for every single thing that happens in your trading. It sounds simple on the surface, but it is incredibly difficult to internalize. Most traders do not realize how often they shift responsibility onto others. They blame the manipulated market. They blame a bad tip from a social media influencer. They blame a sudden news event, or they blame their broker for a slow execution or a wider-than-expected spread. But Douglas is firm. Until you stop blaming outside forces, you will never gain the mindset needed for success. When you blame something else, you give away your power. You are essentially saying, "I can't win unless the market decides to help me." This victim mindset keeps you stuck in a reactive state, avoiding losses until they become catastrophes and constantly looking for someone else to blame for your lack of progress. True power comes from realizing that if you lost money, it wasn't because the market was wrong or unfair. It was because of how you chose to engage with the market. This realization is incredibly freeing. Once you take full responsibility, you stop reacting and start responding. Mistakes stop being emotional scars and start being valuable data points. Trading isn't about being right or wrong. It is about making high-probability decisions, managing risk, and accepting the outcome without guilt or ego. When you take responsibility, you can finally move from the world of luck into the world of skill. You realize that the market is just a neutral stream of information. It doesn't know you exist, and it certainly doesn't have a grudge against you. If you lost money on a trade, it's because you entered at a certain price and the market moved to a different price. That's it. There is no morality in price movement. By owning every result, you become the master of your own destiny. You no longer wait for the market to give you permission to be successful. You create your success through disciplined execution. Section 5. Consistency as a state of mind. To reach the elite level of trading, you must understand that consistency is a state of mind. It isn't a result that you find in a specific strategy. It's a way of being. Most traders believe that consistency comes from having a perfect system that wins 90% of the time. But Douglas turns that idea upside down. He argues that even the most profitable strategy in history will fail if the trader's mindset isn't right. Why? Because trading isn't about logic. It's about how you feel when you are facing total uncertainty. The market is unpredictable. Every single moment in the market is unique. When you enter a trade, you have absolutely no way of knowing for sure what will happen next. This uncertainty throws most traders into a tailspin. It stirs up the primitive brain, the part of us that feels fear, doubt, and greed. These emotions pull you away from your plan. Douglas says that consistent winners have learned to think differently. They don't need to know what will happen next to make money. They have trained their minds to be okay with not knowing. They understand that any single trade is just one of a long series of trades. This is the secret of thinking in probabilities. Imagine your strategy has a 60% win rate over the long term. This means that out of 100 trades, 60 will win and 40 will lose. However, you have no idea what the order of those wins and losses will be. You could have 10 losers in a row right at the start. An amateur trader would quit after the third loss, thinking the strategy is broken. A professional trader, however, treats every trade exactly the same. They follow their plan, they manage their risk, and they accept the outcome, knowing that over time, the math will work in their favor. Douglas points out that most traders already have a system that works, but they lack the mental discipline to follow it when the pressure is on. They hesitate to enter, they jump in too early out of FOMO, or they second-guess their stop losses. This inconsistency in behavior leads to inconsistent results. To fix this, you must shift your focus from the outcome of the trade to the execution of the trade. Stop obsessing over whether this specific trade will win or lose. Instead, obsess over whether you followed your rules perfectly. If you followed your rules and the trade lost money, you still won, because you remained disciplined. This discipline doesn't come naturally. It takes practice to override your biological instincts. But once you adopt this mindset, a sense of calm settles over your trading. You stop chasing trades, you stop fearing losses, and you become a steady, focused operator. You realize that your job is not to predict the future, but to act as a manager of risk. You become a person who executes an edge over and over again with the cold precision of a machine. Section 6. The Dynamics of Perception and Belief. This brings us to a deep dive into the dynamics of perception. Why do two traders look at the same chart and see completely different things? One sees a clear buy signal, while the other sees a sell signal. Douglas explains that we don't perceive the market objectively. We see it through filters made up of everything we've ever experienced. Every win, every painful loss, every childhood belief about money, and every trauma acts like a lens through which we interpret price movement. For example, if you just suffered a massive, painful loss from a breakout trade that failed, your brain will store that pain as a survival mechanism. The next time you see a breakout setup, even if it is a perfect textbook setup, you will feel a pang of anxiety. Your brain is trying to protect you from the pain you felt last time. Your perception is being distorted by your past. You aren't seeing what the market is doing now. You are reacting to what the market did then. This is why trading is so psychologically tricky. We believe we are making rational, data-driven decisions, but more often than not, we are simply reacting to emotional ghosts. Douglas calls this our mental environment. If your mental environment is filled with fear, regret, or unprocessed losses, your judgment will be clouded. You will miss opportunities because you are afraid, or you will hold on to losers because you are desperate to avoid the pain of being wrong. Douglas introduces the idea that our beliefs define our perception. If you believe that the market is out to get me, you will find evidence of that in every candle. If you believe that losing money makes me a failure, you will find it impossible to cut your losses early. The solution is to train your mind to observe the market without judgment. You have to learn to separate the now from the before. Each moment is a unique event. Just because a trade failed last time doesn't mean it will fail this time. You have to learn to see the market not through your wounds or your hopes, but as a neutral flow of information. This requires a high level of self-awareness. You must learn to recognize your own emotional triggers as they happen. When you realize that your perception is biased, you can pause, breathe, and return to your objective plan. You begin to understand that beliefs are not facts. They are just interpretations of reality that you have accepted as true. The good news is that beliefs can be changed. However, changing them requires intense effort and a willingness to confront uncomfortable emotions. You have to ask yourself, is this belief helping me or hindering me? To become a consistent trader, you must systematically replace your old, fear-based beliefs with new, probability-based beliefs. Section 7. The market's perspective versus your perspective. In this section, we explore the powerful shift of adopting the market's perspective. Most traders look at the market as if it were a person, an opponent they need to outsmart, or a friend that should reward them for their hard work. But the market is not a person. It is a neutral entity. It is the collective reflection of millions of participants worldwide, all expressing their own beliefs, fears, and strategies through the act of buying and selling. The market does not care about your bank account balance. It doesn't know your name, and it doesn't care about your dreams of financial freedom. It is simply a stream of information. Many traders fall into the trap of feeling tricked or unfairly targeted. When they get stopped out and the price immediately moves in their direction, they feel like the market did it to them on purpose. But Douglas makes it clear that this is just the ego talking. The market doesn't do anything to you, it just is. To become a consistent winner, you must align your thinking with this neutral nature. That means accepting that the market is always right. If you think the price should go up but it goes down, you are the one who is wrong, not the market. Understanding that price movement is not personal allows you to let go of the need to fight. Douglas uses the analogy of a river. Imagine standing in a powerful river. If you try to force the water to flow in a different direction, you will quickly become exhausted and eventually drown. But if you learn to go with the flow, you can move smoothly and efficiently. Trading is the same. Fighting the market by insisting on your own expectations creates tension, frustration, and costly mistakes. Flowing with the market, accepting what it gives you, and responding calmly leads to clarity and profit. Douglas introduces the concept of mental flexibility. Instead of forcing the market into your rigid expectations, you must become fluid. You must let go of the idea that you know what will happen. You don't need to know what happens next to make money. You only need to align your actions with the current flow of probabilities. When you stop seeing the market as an enemy to be conquered and start seeing it as a mirror of human behavior, you stop fighting and start trading. Section 8. Probabilities and the casino mindset. This is perhaps the most important conceptual shift you will ever make, thinking in probabilities. This goes against everything our brains are hardwired to do. As humans, we seek certainty. We want to know for sure that if we do A, then B will happen. But the market doesn't work in the world of for sure. It works in the world of maybe. Douglas explains that every single trade is an isolated event with an uncertain outcome, yet at the same time, it is part of a larger pattern that is highly predictable over the long run. He uses the analogy of a casino. A casino owner doesn't know who will win any specific hand of blackjack or any single spin of the roulette wheel. In the short term, the results are totally random. A player might walk in and win $10,000 on a single bet. Does the casino owner panic? Does he think the system is broken? Of course not. The casino owner doesn't care about the outcome of one hand or one spin. Why? Because he knows he has a mathematical edge. He knows that over 1,000 spins, the house will win a certain percentage of the time. He is thinking in probabilities. He doesn't get angry when a player wins. He just keeps the game running, knowing that the edge will eventually play out. As a trader, you must become the casino, not the gambler. The gambler is obsessed with the outcome of one specific bet. His emotions are tied to that one moment. If he wins, he is high on dopamine. If he loses, he is devastated. The professional trader, like the casino owner, is focused on the series. Douglas urges you to stop viewing each trade as a live or die situation. Instead, look at every trade as just one of the next 20 or 50 trades you are going to take. If you follow your strategy, some will be winners and some will be losers, but the edge will ensure you come out ahead. This mindset removes the emotional sting of a loss. A loss is no longer a failure. It is just the cost of doing business, like the electricity bill for a casino. The key here is risk management. If you manage your risk and ensure that your winners are larger than your losers, you create a scenario where you can be wrong more than half the time and still be incredibly wealthy. But you can only achieve this if you stop focusing on individual trades and start focusing on the long-term process. You must let go of the need to be right every time. Section 9. The 5 Fundamental Truths. To reprogram your brain for success, Douglas argues that you must install the 5 fundamental truths into your subconscious mind. These are the bedrock of a probabilistic mindset. Truth number 1. Anything can happen. You must believe this in your gut. At any given moment, there are millions of traders in the world. All it takes is one trader somewhere on the planet to enter a large enough order to change the direction of the price. Therefore, no matter how perfect your setup looks, it can still fail. If you truly believe that anything can happen, you will never be surprised by a loss. You will never feel the need to argue with the market. You will simply accept that in this specific moment, the market did something else. Truth number 2. You don't need to know what is going to happen next in order to make money. This is the ultimate ego killer. Most people think trading is about being a prophet or a psychic. It isn't. It is about being a statistician. If you have an edge that wins 60% of the time, you don't need to know if the next trade is part of the 60% or the 40%. You just need to take the trade. When you stop trying to predict the future, the pressure to be right evaporates. Truth number 3. There is a random distribution between wins and losses for any given set of variables that define an edge. This means that even if you have a high probability system, you could easily have 10 losses in a row. This is just how math works. A professional trader knows this and remains calm during a drawdown. An amateur sees 3 losses and abandons their strategy, never realizing they were just in a random cluster of losing trades. Truth number 4. An edge is nothing more than an indication of a higher probability of one thing happening over another. That's it. It isn't a guarantee. It isn't a promise of wealth. It is just a slight mathematical advantage. When you see your setup, you shouldn't feel excited or certain. You should feel the same way a casino dealer feels when someone sits down at a table. You know you have the advantage over time, but you don't care who wins this specific hand. Truth number 5. Every moment in the market is unique. History might rhyme, but it never repeats perfectly. This is why backtesting can sometimes be dangerous if it leads to over-optimization. You have to realize that the people trading the market today are not the same people who were trading it 5 years ago. Their emotions, their capital, and their motives are different. Therefore, no matter how much a setup looks like a past winner, it is its own unique event. When you accept this, you stop expecting the market to behave a certain way, and you start reacting to what it is actually doing in the present moment. Section 10. The 7 Principles of Consistency. Building on these truths, Douglas introduces the 7 Principles of Consistency. These are the daily affirmations of a professional trader. They represent a commitment to a specific way of behaving. Principle 1. I objectively identify my edges. This means you don't feel like the market is going up. You have a clearly defined, written set of rules that tell you when to enter. You are an objective observer of data. Principle 2. I predefine the risk of every trade. Before you even think about how much money you can make, you must decide how much you are willing to lose. If you don't predefine your risk, your brain will try to hide from the reality of a loss once the trade goes against you. Principle 3. I completely accept the risk, or I am willing to let go of the trade. There is a massive difference between knowing you might lose and accepting that you might lose. Acceptance means that if the price hits your stop loss, you don't feel a sting of pain. You simply exit and move on. If you can't accept the risk, you shouldn't take the trade. Principle 4. I act on my edges without reservation or hesitation. In the moment of truth, when the signal appears, you must click. If you find yourself waiting for more confirmation or checking the news, you are trading out of fear, not probability. Principle 5. I pay myself as the market makes money available to me. This is about greed management. You must have a plan for taking profits. Don't wait for the market to tell you when to exit, because by then, the profit is often gone. You must be disciplined in taking what is yours. Principle 6. I continually monitor my susceptibility for making errors. You must become a student of your own behavior. Are you overtrading? Are you revenge trading? Are you skipping trades? You need to keep a journal not just of your trades, but of your emotional state during those trades. Principle 7. I understand the absolute necessity of these principles of consistent success and, therefore, I never violate them. This is the ironclad contract you sign with yourself. Violating a rule isn't just a mistake, it is a betrayal of your own integrity as a trader. Once you violate your rules, you are no longer a trader, you are a gambler. Section 11. The childhood influence on your trading. One aspect that Douglas touches on deeply is the role of our upbringing. Most of us were raised in environments where we were taught that being wrong was bad. In school, being wrong resulted in a low grade. At home, making a mistake always led to getting scolded. In the corporate world, being wrong could result in losing your job. Consequently, our brains are biologically wired to avoid the pain of being wrong at all costs. In trading, however, being wrong is a mathematical certainty. Even the best traders are wrong 40 to 50% of the time. If your subconscious mind still equates being wrong with danger or failure, your brain will physically try to prevent you from taking a loss. It will come up with all sorts of excuses. It's just a pullback. It'll come back. I'll just move my stop loss a bit further. This is your childhood programming interfering with your adult trading. Douglas also explores the child mind versus the adult mind. The child mind is the part of us that wants instant gratification. It wants to be right, it wants to avoid pain, and it wants to win every time. It is impulsive and emotional. The adult mind is the part that understands delayed gratification, risk management, and the long-term goal. The path to success is learning to let the adult mind drive the car while the child mind sits in the back seat. You can't kill the child mind. You can only learn to stop letting it make your financial decisions. Another common limiting belief is the idea that money is hard to earn. If you grew up in a household where parents struggled and always said money was scarce, you will have a hard time accepting easy profits. When you are in a winning trade and you've made $5,000 in 10 minutes, your subconscious might feel uncomfortable. It feels unearned. This leads to self-sabotage, where you hold on to the trade until it turns into a loss, simply because your subconscious doesn't believe you deserve that much money that easily. Breaking these deep-seated beliefs is essential for reaching the elite level. Section 12, the 20 Trade Exercise, a step-by-step guide. To help you install these new beliefs, Douglas suggests a specific, practical exercise, the 20 Trade Exercise. This is the lab work of becoming a professional. It is designed to prove to your subconscious mind that you can be profitable without needing to know what happens next. Step 1. Pick one single setup. It doesn't matter what it is, a moving average crossover, a support resistance bounce, or a specific candlestick pattern. But you must pick only one. Step 2. Define your entry and exit rules with absolute clarity. There should be no discretion. You should be able to give your rules to a 10-year-old, and they should be able to execute them exactly as you would. Step 3. Commit to taking the next 20 occurrences of that setup, no matter what. You are not allowed to skip a trade because you feel it might lose. You are not allowed to exit early because you are scared. You are not allowed to stay in late because you are greedy. Step 4. Use the exact same position size for all 20 trades. This is crucial because it ensures that no single trade has a disproportionate impact on your account or your emotions. Step 5. Be a robot. During these 20 trades, you are not allowed to look at news, you are not allowed to listen to experts, and you are not allowed to change your mind mid-trade. You must be a passive executor of your edge. The goal of this exercise isn't actually to make money. The goal is to prove to your subconscious mind that if you just stay out of your own way, the probabilities will work. By the end of the 20 trades, most traders find that they have made a profit, not because the strategy was a holy grail, but because they finally stopped interfering with the math. This exercise bridges the gap between the mechanical stage of trading and the intuitive stage. Most traders try to jump to intuition before they have mastered mechanics. Mechanics come first. Section 13. The mechanical, subjective, and intuitive stages. Mark Douglas breaks down the evolution of a trader into three distinct stages: the mechanical stage, the subjective stage, and the intuitive stage. In the mechanical stage, the trader is a rule follower. They recognize that they cannot trust their emotions, so they build a rigid set of rules and follow them without question. This is where you learn discipline. This is where you learn to accept risk and think in probabilities. Most traders spend their entire careers trying to reach this stage, and once they do, they are already more successful than 90% of the market. In the subjective stage, the trader begins to use their experience. They still have their mechanical rules, but they start to recognize subtle nuances in the market. They might say, "My setup is there, but the way the market is moving feels sluggish, so I'll take a smaller position." This is a dangerous stage because it is very easy to confuse subjective analysis with emotional interference. You can only move to this stage after you have proven that you can be perfectly disciplined in the mechanical stage for hundreds of trades. Finally, there is the intuitive stage. This is the level of the masters. This is where trading becomes an art form. The trader has seen so many thousands of charts and experienced so many market cycles that their subconscious mind recognizes patterns that the conscious mind cannot even articulate. They feel a flow with the market. This is what it means to be truly in the zone. But Douglas warns that you cannot force intuition. True intuition is the result of years of disciplined mechanical trading. If you try to trade intuitively before you have mastered the mechanical stage, you are just gambling and calling it intuition. Section 14. Entering the Zone. The title of the book, Trading in the Zone, refers to a state of peak performance. Being in the zone is a psychological state where you are completely in sync with the present moment. There is no ego, no fear, no greed, and no regret. You aren't predicting the market, you are simply flowing with it. Information is processed without emotional distortion. When you are in the zone, time seems to slow down. You don't feel a sense of struggle. If the market moves against you, you exit immediately without a second thought. If the market moves in your favor, you stay in until your target is hit. You are not thinking about the money you could lose or the things you could buy with the profit. You are simply focused on the now. However, you cannot enter the zone if you have internal conflict. Internal conflict comes from having expectations that the market does not meet. If you expect a trade to win and it loses, you feel a clash between your belief and reality. This clash creates emotion, and emotion pulls you out of the zone. To stay in the zone, you must let go of all expectations. You must accept that the market can do anything at any time for any reason. When you have no expectations, you cannot be disappointed. When you cannot be disappointed, you stay calm. When you stay calm, you stay in the zone. Section 5. The Paradox of Control. One of the most profound realizations in Douglas's work is the paradox of control. In almost every other area of life, school, sports, career, the more you try to control the outcome, the more successful you are. If you work harder, study longer, and exert more willpower, you get better results. In trading, the opposite is true. The more you try to control the market, the more it will control you. You cannot will the market to move in your direction. The harder you try to make money, the more likely you are to make emotional mistakes that lead to losses. Success in trading comes from surrendering control over the market and exerting absolute control over yourself. You have to reach a point where you truly don't care whether the next trade is a winner or a loser. This sounds impossible to many, but it is the hallmark of the professional. They care about the process. They don't care about the individual outcome. They understand that their wealth is a result of their long-term edge, not any single trade. When you let go of the need to control the outcome, you gain a level of freedom that allows you to trade with clarity. You stop fighting the market and start dancing with it. Section 6. Money as a reflection of mindset. We often think of money as an external scorecard, But in trading, your account balance is a direct reflection of your internal state. If your mind is cluttered with fear, your account will show the results of that fear. Missed opportunities and early exits. If your mind is cluttered with greed, your account will show the results of that greed. Over-leveraging and holding losers too long. Douglas argues that the market is the ultimate mirror. It doesn't lie, and it doesn't offer excuses. It shows you exactly who you are in this moment. If you want more money in your bank account, start within. You reshape your inner world. You also change how you think about money. You start by building a mindset that feels safe with money. You train yourself to become the kind of person who welcomes wealth. You also learn to manage it wisely. You grow more confident about holding on to it. This means developing a mindset of abundance rather than scarcity. A scarcity mindset makes you afraid of losing what you have, which leads to tight, fearful trading. An abundance mindset realizes that the market offers endless opportunities every single day. If you miss a trade today, there will be 10 more tomorrow. When you trade from a place of abundance, you are no longer desperate. And in the markets, the desperate person always loses their money to the patient person. Section 17. Managing the emotional roller coaster. Even with the best mindset, emotions will still arise. We are human after all. The difference between a professional and an amateur is how they manage those emotions. When a professional feels a surge of greed or a pang of fear, they recognize it immediately. They don't let it drive their actions. They might even step away from the screen for an hour to let the emotion subside. Amateurs, on the other hand, are often unaware that they are being driven by emotion. They think they are making a logical decision to move their stop-loss, but they are actually reacting to fear. They think they are being smart by doubling down on a loser, but they are actually reacting to the ego's need to be right. Developing self-awareness is a key part of the journey. You must learn to monitor your internal state as closely as you monitor the charts. If you feel your heart racing or your palms sweating, that is a signal that you are too emotionally invested in the outcome of the trade. It means you have forgotten the fundamental truths and are once again seeking certainty in an uncertain world. Section 18. The Mastery of Self. As we move toward the conclusion of this masterclass, it becomes clear that trading is not really about the markets at all. It is a journey of self-mastery. Every day, the market presents you with the opportunity to succumb to your lowest instincts, fear, greed, anger, and pride. And every day, you have the opportunity to rise above them. The journey from a struggling amateur to a consistent professional is not a journey of learning more about technical analysis. It is a journey of shedding the layers of your ego. It is about becoming a person who can sit in the face of total uncertainty and remain perfectly calm. It is about becoming a person who has the integrity to follow their own rules even when no one is watching. Mark Douglas often said that trading is one of the hardest jobs. It looks simple from the outside, but it is very demanding. Trading pushes against our natural instincts about money, risk, and being right. Our minds want quick rewards and clear certainty in every decision. Good trading often requires the exact opposite of what feels comfortable. We must accept that losses are normal, not a personal failure. We need to stay calm under pressure, even after painful setbacks. We also have to follow our rules and plan, not our emotions. We are wired to seek patterns, to seek certainty, and to avoid pain. Trading asks us to accept real randomness in price movements every day. In trading, even strong analysis cannot remove that basic uncertainty. The market does not follow our wishes, hopes, or personal beliefs. It reacts to countless forces that no one can fully predict. As traders, we must live with this uncertainty in every decision. No single trade is guaranteed profit, no matter our skill or preparation. Every position we open carries risk, whether we admit it or not. With experience, we learn to face losing trades without freezing or panicking. Losses still hurt our pride and emotions, and that is normal. Over time, we recover faster and respond with calm, practical steps. Each loss becomes a useful data point in our long-term process. We study what happened, adjust, and move forward with more knowledge. Instead of obsessing over one trade, we judge results over many trades. Our goal becomes consistency across hundreds of trades, not perfection on one. This mindset helps protect both our account balance and Section 19, the journey forward. If you have listened to this entire masterclass, you now have the conceptual framework needed for success. But knowledge is not enough. You must put this into practice. You must begin the 20-trade exercise. You must start journaling your emotions. You must begin the long, slow process of reprogramming your beliefs. There will be days when you fail. There will be days when you let your emotions get the better of you and you violate your rules. When that happens, do not beat yourself up. That is just the child mind taking over for a moment. Simply acknowledge it, take responsibility for the result, and return to your discipline. Consistency is not a destination, it is a practice. It is something you must choose every single day with every single trade. The more you choose discipline over emotion, the easier it becomes. As you keep practicing these habits each day, a new you appears. This version of you is calmer and less driven by fear. You become a disciplined, probabilistic trader who thinks with clear logic. You see every trade as probabilities, not a personal verdict. You follow your plan, manage risk, and avoid emotional decisions. Over time, that trader identity grows stronger than your old habits. It slowly becomes the main personality that guides your trade. Section 20, Conclusion, the psychological code unlocked. Picture that successful trader from the very beginning of this course. Imagine them sitting at their screen, calm, steady, and fully present. Markets move fast. Charts jump wildly. Headlines scream across the news. Yet this trader breathes slowly and watches each candle form. They are not guessing or chasing every sharp move they see. They follow their written plan, rule by rule, step by step. Each trade is prepared in advance, with clear risk and target. They size positions carefully, protect capital, and avoid impulsive decisions. Trade after trade, these steady habits become their normal daily routine. Over many years, this calm approach builds real, lasting account growth. Profits compound, drawdowns stay controlled, and confidence grows from experience. There is nothing magical, secret, or inhuman about this trader. They simply make clear choices, even when emotions try to interfere. They repeat those choices consistently, with patience, discipline, and they have simply done the internal work that the 95% refuse to do. They have come to see financial markets as a mirror of people. This mirror shows our hopes, fears, greed, trust, confusion, and dreams. They watch these feelings closely and learn from every rise and fall. Over time, they have mastered what appears in that human mirror. Trading in the zone is not a strange magic trick. It is a real mental state that skilled traders can develop. You reach it by letting go of ego and control. You accept that the market is uncertain and unpredictable by nature. When this clicks, each trade feels like one small step only. No single trade defines you, your skill, or your future. Each trade simply becomes one outcome inside a larger game of probability. It is the result of total responsibility, iron discipline, and a deep understanding of the nature of beliefs. As you go back to your charts, remember the 5 fundamental truths. Remember the 7 principles of consistency. Remember that every moment is unique, and you don't need to know what happens next. Stop fighting the market. Stop trying to be right. Start being a manager of risk and a disciplined executor of your edge. The market is like a wide ocean of chances and choices. It is full of real opportunity every single trading day. The only person who can keep you out is you. Your doubts, fears, and impatience build walls around that abundance. When you learn to guide your thoughts, you change your actions. When you change your actions, your trading results begin to change. Master the mind first, and money naturally starts to follow. This mindset is the real edge, the hidden code of trading. This idea is simple, but it is powerful and true. This is what it means to truly trade in the Section 21. Scenario Analysis. The Anatomy of a Mistake. Imagine a real trading moment filled with intense mental pressure. You sit at your desk, watching the S&P 500 move. Each candle appears on your 15-minute chart, one after another. You lean closer, searching the chart for any useful clue. Over time, a familiar double bottom pattern begins to take shape. The price drops sharply, then bounces higher from support. After that bounce, it turns downward again toward the same area. Your heart rate increases as the candles approach that earlier low. Every small move plays with your hopes and fears. You wonder if buyers will defend that level a second time. Your brain starts matching this pattern with the crowd psychology discussed earlier. You begin to see not just lines, but traders. This is your favorite setup. You have already backtested this setup many times before. Each test showed similar results and built your trust. The data tells you it has a strong, reliable win rate. You are not guessing or trading on a hunch. With that confidence, you enter the trade exactly as planned. You choose your usual position size for this setup. It is the standard risk you are comfortable taking. Your stop loss sits 20 points away and protects your downside. If price moves against you, the loss stays controlled. Your profit target waits 60 points away from your entry. This target offers 3 units of profit. You risk only 1 unit to pursue those 3 units. That structure creates a clear reward-to-risk ratio in your. Initially, the price moves in your favor. You are up 10 points. You feel a surge of dopamine. Your brain starts calculating the profit. If this hits my target, I'll have enough to buy that new laptop, you think. You are already mentally spending the money. You have moved from objective observer to expectant participant. Suddenly, the market shifts. A news headline drops, or perhaps a large sell order hits the tape. The price begins to drop rapidly. Your 10-point profit turns into a 5-point loss. Then a 10-point loss. Then 15 points. You are now 5 points away from your stop loss. How do you feel? If you are like most traders, you feel a sense of panic. Your heart is racing. You feel a physical tightness in your chest. This is your child mind, reacting to a perceived threat. You enter the trade absolutely sure you are about to win. Everything in your setup looked perfect and totally under control. Your confidence felt sky high, almost buzzing in your chest. In your mind, the profit was already sitting in your account. You were not just hoping, you were already counting it. You started planning exactly how that money would fix real problems. You pictured paying late bills and clearing those old heavy debts. You imagined the relief on your face as the pressure eased. You saw a better trading setup with faster gear on your desk. You imagined sharper screens, more charts, and smoother execution on every order. You even saw yourself taking a small personal reward. You pictured a nice meal, something you rarely allow yourself. You thought about a short trip, a break you felt you deserved. In your head, that trip already felt booked and confirmed. When the trade suddenly turns against you, those images vanish instantly. Your screen shows a loss, and your body tightens with shock. Your throat feels dry and your chest feels squeezed from inside. It feels like someone reached into your pocket and stole your cash. The loss hurts more because you already lived that win. In your mind, it was real before the. At this moment, you face a choice. The adult mind says, my stop loss is there for a reason. If the price hits it, the trade is over. I tell myself, I fully accept the risk here. I also accept every possible consequence. In my mind, the child mind wakes up. It starts whispering a different plan. It says, just slide your stop loss a little lower on the chart. It adds, no one will notice this small change. It pleads with you, move it, another 10 points farther from entry. It insists this extra room will keep you safe. It promises the price will bounce back soon and rescue the trade. It swears you will avoid the pain of a loss. This voice sounds helpful and caring. In truth, it quietly pulls you toward danger. With each tiny adjustment, your risk slowly grows. It creeps far beyond your original. You don't want to be wrong, do you? You don't want to lose that money, do you? When you follow the child mind, you move your stop loss. That single choice breaks your consistency rules in a serious way. Your trading plan stops guiding you in that instant. Emotion takes over and starts calling every shot for you. From the outside, it may still look like trading. On the inside, you are simply gambling with your account. Price might bounce back and rescue this one trade. You might even close it with a small profit. In the bigger picture, you have paid a heavy price. You have trained your brain to distrust your own rules. Each time you move a stop loss and avoid pain, relief appears. That feeling of relief rewards the rule-breaking behavior inside your mind. Your brain quietly learns that your rules do not truly matter. It starts to believe that ignoring rules keeps you safe. This belief grows stronger with every small rule you decide to break. At some point, the market will not bounce the way you hope. Your extra 10 points of risk will not be forgiven. One sharp move against you can erase many weeks of progress. In a single bad decision, your account can suffer massive damage. Under extreme conditions, that damage can completely destroy the entire account. The trade will end, but the habit will remain stronger. Your future decisions will feel easier to bend and break. Each broken rule will push you further away from consistent success. Protecting your stop loss protects more than money in your account. It protects your discipline, your confidence, and your long-term growth. Guard that habit carefully because the professional trader is in this same situation. They still feel that rush of dopamine. They notice a faster heartbeat. They feel a small spike of fear. Through many hours of practice, they have trained their minds carefully. They observe these feelings with calm attention. They treat emotions like passing clouds in the sky. They respect the signal, but they do not obey it blindly. Emotional surges never push them into sudden or reckless decisions. When price reaches their stop loss, they focus on the plan. They click the close button right away. They exit the trade without doubt or hesitation. They do not feel guilty or beat themselves up in any way. They accept that losses are part of trading from the very beginning. Each loss is expected and allowed. This trade is simply one of the losing 40%. They have planned for this outcome in advance. It belongs to the normal pattern in their trading plan. That plan has been tested and trusted over many trades. Their breathing stays slow and steady. Their body feels loose, and their shoulders stay soft and relaxed. Their jaw is not tight. Their hands are not shaking. Their attention moves away from the pain of the loss. Their focus returns to the trading process. They watch the charts with patience and a steady, curious focus. They are not in a hurry, and they do not chase. They simply look for the next clean setup. It must fit every rule in their plan. Their mind stays steady and quiet. It is calm like a still lake. Section 22. The illusion of the Holy Grail. Many traders spend years stuck in the Holy Grail phase. During this stage, they keep hunting for a perfect trading setup. They believe that one special mix of indicators can unlock endless profit. They picture a magic chart that almost never shows losses. They test new settings every week and change tools constantly. They might tweak a MACD line and tighten Bollinger Bands together. They convince themselves that better numbers will predict every market move. They hope one flawless formula will erase doubt, fear, and hesitation. In real life, they chase a math fix for trading doubts. The real issue sits in confidence, discipline, and emotional control. Douglas explains that there is no Holy Grail indicator because the market is made of people, and people are not perfectly predictable. Even if you found a setup that won 90% of the time, the 10% of losers would still ruin you if you didn't have the right mindset. Most traders who find a winning system eventually lose all their money because they don't know how to handle a losing streak. They lose faith in the system, they start tweaking it during a drawdown, and they end up destroying their edge. The real Holy Grail in trading is never some secret indicator. The real power comes from your skill reading price and market behavior. You watch how price moves up, down, and pauses over time. You notice where buyers step in and where sellers push back. Bit by bit, you train your mind to think like the market. You stop guessing and start responding to what price clearly shows. With that understanding, you can plan trades with purpose and clear rules. You can execute those trades calmly, even when the market feels intense. It is the ability to accept that you don't need to be right. Once you stop looking for the holy grail in the charts and start building it in your mind, you become unstoppable. You start to realize you can still build real wealth. You do this through trading, even without winning all the time. You follow a clear trading plan that you trust and respect. That plan might win only about 40% of your trades. At first, this number feels low and a little scary. Many new traders believe they must win on almost every trade. That belief is wrong and often leads to bigger losses. The real secret is discipline every single day, especially during stress. You cut your losing trades quickly and do not argue. Each loss stays small, controlled, and easier for your account to handle. You allow your winning trades to run longer when they work. Those winning trades grow much larger than the many small losses. Over time, the big winners outweigh the small losers in Section 23, the psychology of winning streaks. A winning streak can feel safe, comfortable, and even exciting. You start to believe nothing can go wrong with your trades. This feeling often makes you relax your rules and take bigger risks. Overconfidence during hot streaks can be just as dangerous as losses. Long losing runs hurt your balance. Long winning runs can quietly damage your discipline and judgment. Treat both situations with the same calm, careful, rule-based mindset. After you win 5 trades in a row, your brain starts changing. Winning 6 or 7 in a row can push this even further. It can slip into a dangerous psychological state called euphoria. During euphoria, you feel unbeatable and far more confident than usual. That extra confidence makes you ignore risk and take bad trades. Over time, this overconfidence can quickly lead to big and painful losses. You begin to feel like you know what the market is going to do. You start to feel like you have a special connection to the price action. This feeling of euphoria builds up quickly. It often pushes people into risky overconfidence. In trading, you might feel tempted to suddenly double your position size. You tell yourself you are on a lucky roll today. You believe the market finally understands your style and rhythm. You might start taking trades that barely follow your written rules. You begin to ignore your stop levels and risk limits. In your head, it all sounds safe and almost guaranteed to work. Your mind keeps saying that this time is different from the past. These thoughts slowly pull you away from your tested trading plan. They erase the discipline that protected your account before. That sudden impulse is not real skill or experience at work. It is pure ego trying to take control of your decision. It has convinced you that you are bigger than the market. For almost every individual trader, the worst account drop follows recent wins. To them, it looks like a sudden crash after a hot streak. The trader starts to feel unstoppable after a few winning trades. Their confidence grows so fast that careful thinking slowly disappears. They begin taking reckless risks, believing the winning streak will never end. The market eventually turns against them because markets always change direction. They are heavily leveraged, using borrowed money to control a huge position. Their account looks large on paper, which feeds even more confidence. They see warning signs on the chart and from their broker. They ignore every warning, convinced the market will soon move back. They stubbornly refuse to close the trade and protect their capital. They will not accept a small loss, which could. A single careless trade can wipe out weeks or months of progress. All those slow, steady gains can disappear within just a few minutes. Your winning streak can vanish suddenly, and your balance can drop sharply. In many cases, that one big loss also eats into capital. When the trade size is too large, your account can turn negative. That single mistake can push your growth back much further than expected. It can also damage confidence, which makes the next decisions even harder. This is why disciplined position sizing and clear risk limits matter greatly. Treat every trade as important, especially after a long winning. The professional trader handles a winning streak with the same detachment as a losing streak. They pause and remind themselves, This winning streak is just random luck. It is only a cluster of wins, not some special magic skill. These recent trades feel good, but they do not prove expert talent. A few victories in a row do not make them special. They are not a trading genius. The streak does not promise that the next trade will win. Each new trade still stands alone as one independent event. Past wins do not reach forward and change the future outcome. The odds on the next trade stay exactly the same as before. They say this to themselves slowly and calmly before placing another trade. They notice the strong urge to double their position size. Their mind wants to chase more profit. Instead of giving in, they trust their written plan and trade rules. They keep their position size steady and exactly the same. They always follow their rules closely, and they do not make exceptions. They stay humble, knowing that the market can humble them in an instant. Section 24. How to journal for psychological success. Many traders know they should keep a trading journal. They open it after each trade and rush through the process. It feels like another task to finish, not a useful tool. They only write quick technical details and skip almost everything else. They note the entry price and they note the exit price. They also write down the profit or loss for that trade. The journal becomes a spreadsheet on paper with no real story. They almost never record their thoughts before entering the trade. They rarely describe their feelings during the trade or after it. Because of this, they miss patterns in fear, greed, and hesitation. They often skip the real reasons that push them to click buy. Those missing details are what turn a simple log into a. While this is useful for tracking your edge, it does nothing for your psychology. To truly master your trading mindset, you need a psychological journal. Imagine it as your private coach that lives on paper. It watches every move and helps you see patterns. Turn it into a daily habit, just like checking the markets. Place it beside you whenever you sit down to trade. Keep the journal open during your whole trading session. Each time you place a trade, pause for a brief moment. Update the journal before you rush to the next decision. For every trade, write exactly what you did in clear steps. Explain why you entered, why you exited, and why you sized. Describe what you felt in your body, even small sensations. Notice tight shoulders, fast breathing, or a knot in your stomach. Also write what you were thinking before, during, and after entry. Include thoughts about fear, greed, confidence, doubt, or overconfidence. Mention anything you tried to ignore, push away, or justify. With time, this journal becomes your mental scorecard and honest mirror. It shows your real habits and helps you. When that trading signal first appeared on my screen, I paused. I took a slow breath and checked in with myself. I quietly asked what I was really feeling inside. Very quickly, I noticed a strong rush of excitement in my body. My heart started beating harder and faster than a few seconds earlier. My breathing became shallow and my chest felt slightly tight. My eyes locked onto that single setup on the chart. Everything around me seemed to fade into the background. There was a strong urge to jump into the trade immediately. My mind wanted action and did not want to slow down. My thoughts were racing ahead, and I ignored ideas about risk. That kind of powerful emotional spike is extremely important. It has a strong effect on your trading decisions. If you miss it, it can quietly push you into impulsive trades. Those trades often feel exciting at first, but bring regret later. Learning to notice this whole feeling in your body is essential. It is a real skill that protects you while trading. When you calmly give that feeling a simple name, you gain control. You might say, "This is greed," and speak it to yourself. You might say, "This is fear," or "This is pure excitement." By naming it, you create a little space. That space sits between the feeling and your next action. Inside that space, you can slow down and breathe. You can think through the trade with a clearer mind. Over time, this habit helps you make clearer and calmer choices. It supports careful and deliberate trading decisions. Do you feel any fear at this step right now? Notice the small hesitation here. It shows a brief delay before the action. What was going through my mind while this trade was open? Was I calmly following my plan? Or was I watching the profit and loss every few seconds? Did I feel pressure to move my stop loss? Even though the chart had not changed at all, did I follow my rules perfectly? If not, why? How do I feel now that the trade is closed? By reviewing this journal at the end of every week, you will begin to see patterns. You might start to notice certain patterns in your own trading behavior. For instance, when Monday morning trading opens, your body might instantly tighten. You pause, feel tense, and your breathing becomes shallow. You stare at the screen and hesitate to place a new order. After a losing trade, you might rush into extra trades right away. You feel a powerful urge to win back the loss quickly. Without taking time to think, you jump into the market again. You act without a calm mind or a clear step-by-step plan. When this happens again and again, these reactions turn into strong habits. These habits guide your decisions, your risk choices, and your trading. Once these patterns are conscious, you can begin to work on them. You move from being a slave to your emotions to being an observer of them. Section 25, the final transformation. The shift from struggling trader to true master takes time. It does not happen in one sudden aha moment. It grows through many small insights and consistent practice. It is a slow, steady transformation. It is like the growth of a tree. You don't see it happening in real time, but when you look back a year later, the change is massive. With steady practice over time, you begin to feel real change. You notice your mindset growing stronger and more balanced each week. A losing trade still hurts, especially during those first sharp minutes afterward. Your heart might race and your thoughts might jump around quickly. Instead of panicking or reacting blindly, you pause and breathe slowly. You remind yourself that losses are a normal part of trading. You accept what happened without blaming the market or yourself. That single loss no longer destroys your confidence anymore. It does not ruin your mood or your entire day. You stay calm and return to your trading plan. You follow each step carefully, just as you practiced. You focus on execution instead of on the money you just lost. After the trade is fully closed, you review it calmly. You look at what went right and what went wrong. You take the lesson from that trade and keep it. You might write it down in your trading journal. You move forward into the next trade. You will know you are trading like a true professional. You have reached this stage in your mindset. You can sit and watch the market for 3 full days. You do not place a single trade during that time. Your setup has not appeared, and that is completely acceptable to you. You feel calm, focused, and patient while you wait. You notice no urge to jump in or chase moves. You feel no itch in your fingers anymore. You feel no fear of missing out on any trade. You are simply following your trading plan with discipline. You let the market come to you instead of You will know you are a professional when you realize that the money is just a byproduct of your excellence as a human being. Mark Douglas gave us the map, but you must walk the path. It is a path of discipline, responsibility, and radical self-honesty. It is not an easy path, but it is the only one that leads to true, lasting success in the financial markets. Use these lessons in your own projects. Watch how your skills grow. Internalize the 5 truths. Keep using the 7 principles in your daily work. Repeat them often until they feel natural in every situation. Complete the 20 trade exercise to practice your strategy. Take 20 trades in a row, following your rules carefully. And slowly but surely, you will find yourself in the zone. You will find a level of peace and prosperity that few ever achieve. The market is waiting. Your future truly belongs to you. Every choice you make today helps shape it. When you learn to control your mind, you guide your life. You move with clear purpose. With that clear, focused mind, the world of trading opens. You can make better choices.